The Aussie and Kiwi dollars are weak, along with the yen, against a dominant US dollar. All eyes this week are on Australian inflation and whether it will knock the RBA off its track towards a rate cut by November. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes was surprised by what he found out about iron ore demand on a trip to China.
I went there, like I think a lot of other people, suspecting that the property market would be a massive drag on demand for steel and iron ore, but I came away actually a lot more positive.
But first, in 5 and 5 with ANZ. After last week's surprises in both directions from central banks, Taiwan hiked and the Swiss National Bank cut, ANZ Group Chief Economist Richard Getzinger says global interest rates are entering a new phase.
I've been calling this period, reminding people this is a mid-cycle slowdown, but calling it interest rate purgatory, that in these sorts of mid-cycle slowdowns, interest rate moves are not linear, they're very data dependent, and they're not correlated across countries to a particular degree. And all of those things are different from the last couple of years. And I think it's taking people a little while to recognise not all central banks will be moving in the same direction at the same time with the same degree of vigour. So if your role is just focused on picking interest rates, strap in for a challenging year. I think it's going to stay quite challenging.
Number 2, one currency to watch this week is the yen, after last week's dovish hike. That's helping to bolster the US dollar too. It begins the week strongly, given markets have wound back their expectations of Fed rate cuts to just 2 or 3 this year. The Aussie dollar begins the week down 0.8% at 65.14 US cents, while the Kiwi dollar starts down at a 4-month low of 59.95 US cents. ANZ economist Bansi Madhavani sees the pressure downwards on the yen.
We do think that it's quite likely that the Bank of Japan will not be hiking further through the course of this year. They do want to see signs of inflation pressures continuing to remain firm in the economy and for the 2% inflation target to be met on a sustainable basis. And that's something that's weighing down on yen.
Number 3. Richard says the Bank of Japan's hike last week, its first since 2007, and the end of nearly a decade of negative interest rates, was significant, but doesn't necessarily signal the beginning of a sequence of hikes.
I think we need to stand back a bit and rather than looking at it as what's the next monetary policy action from the Bank of Japan, stand back and look at the economy and say kind of where is the Japanese economy and is it doing something different from what we've seen historically? And I think it is. I think that's why the Bank of Japan was able to hike. The economy is a bit structurally stronger. Female participation in the labour market's quite high, certainly well higher than the US. Foreign direct investment has been coming back into Japan. But I think in many ways, Japan is back.
Number 4. One key number to watch out for this week is Australian inflation for February, which is due on Wednesday. Yes, Richard.
We're expecting a slight rise in the month from 3.4 to 3.5 year over year, but that sort of number should be consistent with about 0.5% for Q1. For headline, 0.5, obviously do the maths, that's annualising at the bottom of the Reserve Bank's target band. If you take the last 2 quarters together, it's annualising a bit below the midpoint of the target band. So you do certainly have a divergence between tradable inflation, which is very soft, and services inflation, which is higher. But services inflation also primarily reflects wages, and the broad suite of indicators very clearly suggests the labour market is past its peak point of tightness, and we'll start to see wage pressure moderate.
Number 5. So all that means the RBA is still on track to cut in November.
The reality is, even with the strong labour market number last week, the data trend is consistent with the next move being a cut. It's impossible to argue that the risk of a hike is higher than a cut. The risk of a hike at some point is not zero, but certainly in the very near term, it's tiny. And all the broad unfolding evidence in Australia is very consistent with the next move in interest rates being down. Our view is not until later in the year. November is our current pick.
Richard Getzinger there. Now, in today's bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at why iron ore prices have defied expectations of weakness As always, it's mostly about China, and he's just come back from a trip there.
I went there, like I think a lot of other people, suspecting that the property market, would be a massive drag on demand for steel and iron ore. But I came away actually a lot more positive. I spoke to shipping companies, manufacturers, auto companies, as well as the property developers, and I got a real sense that demand in those non-property sectors was actually holding up pretty well. And it got me thinking. I did a lot more work around the data coming out of those markets and those sectors for steel and iron ore. And look, it actually paints a relatively positive picture. I mean, yes, steel from the property sector is by far the number one market for it. It takes up about a third of all steel, but the cumulative effect of the growth that we're seeing in those other sectors actually means that overall steel consumption should actually rise this year. So it was a fruitful trip, and I think from the perspective of the international market, just focusing on one particular segment can be a bit disingenuous. And I think when you look at it as a whole and you actually get your feet on the ground and see what's happening, it's not as bad as, I suppose, some of the headlines suggest.
Apart from the property development sector, the private property development sector, there are other types of houses being built and, of course, many other things being built, including ships and cars and other machinery. Could you talk about those other sources of demand?
Yeah, well, at the recent National People's Congress, there was once again, a focus on social housing. Now, this is essentially, subsidised housing for people who can't afford, obviously, the property in the private sector. And look, it certainly is taking up a much bigger chunk of the market now, probably a little bit less steel intensive than, the private residential market, but still, it is providing some support to overall steel demand. And then the markets like shipping, China is one of the world's biggest shipping makers now, and clearly, with trade particularly strong, that has been an increased focus. It's also the world's biggest auto market, biggest manufacturer and biggest exporter, and it is certainly focused on the EV segment in particular, which grabs the attention for critical minerals, but steel is also fairly critical in its use as well. And, that's obviously growing at very strong rates at the moment.
So how do you think this all comes together to produce the demand side, at least, of the iron ore price?
Yeah, well, I think the way we look at it, the steel demand itself will, edge up slightly this year. We're only forecasting a rise of 0.5%, but that's certainly a lot higher than, I suppose, what the property market weakness would suggest. But when you combine that with lower growth in supply, so a lot of the major iron ore producers have cut back a lot of their large projects they had in the pipeline, and so growth is starting to fall. We see it at sub sort of 2% this year. The iron ore market itself actually looks relatively tight. So we have it essentially in a balanced position at the moment, which I wouldn't suggest you would expect to see particularly low prices. So that's why we see iron ore holding up at sort of these current levels, at around $100 a tonne, as opposed to some of the more doomsday forecasts out in the market at the moment of $70 or $80 a tonne.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, March the 25th. Catch you tomorrow with a look ahead at key US inflation data later this week. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.